Hello everybody and welcome to the financial planning update for August 2022. Given everything going on in the markets at the moment, I'm going to spend a little bit more time than usual on some of the charts and the more technical issues, just to try and explain what's happening in global markets and also explore some of the rather unique and unprecedented things that we see going on in certain sectors of the market as well. So we'll start off as we usually do with our review of the main global market indices. The story really that's played out through the whole year continues in that the UK is the notable outperformer among the pack and indeed is the only major global market to post positive returns this year to date. Notice, however, that the US market is making up some of that lost ground and the gap has closed very substantially since the middle of June, July time, where the gap was much larger. So the US is making up some ground and in fact has closed the majority of the gap between the S&P 500 and the FTSE 100, but the UK is still the standout performer this year so far. I've also added in this time the European market just to show that the European market really is struggling versus some of its global peers. I think those issues are fairly well publicised, but it's interesting just to highlight the contrast between the UK and the rest of Europe. Now, interestingly, all of this pales into comparison when we add in the gilt market, the UK government bond market. And we can see here that the all stocks index, so this covers all major UK bond issues, is down nearly 19% year to date. So the bond market really has struggled. Of course, that's in light of rising interest rates. Now, there's two or three things to highlight here. The first of which is to say that we have been very significantly underweight in UK bonds within our portfolios for many years now, and we've maintained that position to the current point in time. Although, because the prices of bonds have now fallen so substantially, the yields on offer, the income, the regular return that they provide, has now increased to a far more attractive level. So we may now be reaching the turning point where it's worth considering adding some more bonds back into portfolios, and these are very active discussions going on within the investment committee at the moment. We also see here the divergence between the UK large cap businesses and the smaller companies within the UK. Now, this picture here looks just at the first half of the year up until the end of June. And we can see here the FTSE 100 almost neutral during that first 6 months of the year. Contrast that though with the FTSE 250 and the smaller companies index, both down nearly 20%. So we can see here that although the UK market is the real outperformer, it's pretty much exclusively the FTSE 100, that the largest companies within the UK market, that are driving that outperformance. And in addition, the outperformance, not just in the UK, but really the growth that's being generated globally, is very concentrated within just a tiny handful of sectors. So these are global market indices for different sectors, again, just focusing on the first half of the year up until the end of June here. And we see really that there's only two sectors that have driven significant returns. Unsurprisingly, the energy sector is doing incredibly well, giving rising utility prices at the moment. And also we have some of the usual sin stocks that are doing rather well. Tobacco companies doing quite well in this environment. And then we see modest growth from both utilities and consumer staples, and that will include things like supermarkets, pharmaceuticals and things like that. Every other global sector, or every other major sector anyway, is showing losses for the year. Some of those fairly modest, others far more significant. But notice the bottom of this table here, we see unsurprisingly technology, consumer services and media being the sectors that are suffering the most, in addition to consumer discretionary. So none of this is particularly surprising given the environment that we're in, but it's really interesting to note just how concentrated the growth has been across global markets. So in terms of how that translates into portfolio performance, we did see significant recovery really through to the middle of August. And since then, there's been further fears raised around interest rate increases, or more importantly, the pace of those interest rate increases. As inflation continues to run away, I think that the likelihood is we will see faster and more significant interest rate rises across the board here in the UK, in the US and in Europe, which of course are the three major central banks that the markets keep an eye on. So that's had a detrimental impact on performance during the last couple of weeks. However, it's interesting to note that the portfolios have sort of retaken their rightful place in the pecking order, and we now see that the adventurous portfolio is the best performer during the year. Now, as always, it's important to put this into a slightly longer term perspective. And even if we zoom out and take a 2-year view here, rather than just focusing on this current calendar year, we see that the adventurous and the balanced portfolios posting very, very decent gains. The cautious portfolio we really include just for reference. We have very, very, very few clients in that portfolio, and it contains a very significant bond component, which is the reason that that one has struggled slightly, but the vast majority of clients will be in the balanced portfolio or even something slightly more adventurous. So as always, it's important to take a longer term perspective. And finally, in terms of the graphs and charts for today, the difference between the balanced active and passive portfolios, as we often explore, the gap has closed very slightly since we did the last review at the end of July, although still a reasonably significant divergence between the two, which just shows the struggle that active managers are having during these markets. So something we will continue to keep an eye on, but suffice to say that active managers have struggled to find any real growth in these markets, and that's not particularly surprising considering that the vast majority of asset classes have posted either neutral or negative figures year to date. So a few things to bear in mind. Of course, we know now that interest rates are rising across the board. And the key takeaway, I think, from that is that cash accounts, once again, are paying something more meaningful. And what I mean by that is that they're paying now something more than effectively zero. It's important to note, however, that cash accounts returns are still really quite pitiful when compared to the inflation numbers. We all know inflation is now well into double digits in the UK. Some forecasts, some commentators are now projecting inflation north of 22%. Don't get me wrong, that's very much on the extreme end of projections, and that's only a limited number of commentators that are suggesting those kinds of numbers. But I think it's probably reasonable to assume that the inflation number will get worse before it starts to get better. So in terms of an action plan on the back of this, 2 takeaways really, just to prepare for this new environment. Once again, it is worth shopping around for your cash savings rates. Now, I'm not suggesting that cash is a particularly attractive asset class, as is normally the case. And in fact, the difference, the delta between cash rates and inflation is greater than it has been for many, many decades. So although interest rates are going up, the inflationary risk of holding cash is much more significant than it has been for a very long time. So of course, all of us need to hold some level of cash, and it's worth getting the best possible return on that cash. So once again, it is worth shopping around for those savings rates. This is something perhaps we haven't been doing a great deal of for the last decade or so, because rates have just been universally poor across the board really. But there is now more competition entering the savings market, and as usual, some providers are being far more diligent in increasing their rates in line with the base rate versus others. So you might start to see significant divergence between different providers. The other thing really to think about is any mortgages or borrowing. We've really grown accustomed to mortgage and borrowing rates very close to zero, and of course that's changing incredibly rapidly now. Mortgage lenders will tend to try and be a step or two ahead of the market, so very often when interest rates start rising, you'll see mortgage rates rising by a greater amount to try and preempt what's going to come next. So I think if you haven't done so already, now's a really great time to review your mortgage rates and think about locking in as long and as low as you possibly can. And finally, it's worth using the current market downturn as an opportunity to deploy any excess cash that we maybe have on the sidelines. As I've just mentioned, the inflationary risk of holding cash is greater than it has been for many, many decades, probably since the 70s, to be honest. So although, yes, we want to hold some cash, it may be worth using this current blip in markets as an opportunity to invest some of that money with a hope of greater returns in the future. So that's everything for today. I hope you found today's update useful. As always, if you need any assistance with your own financial planning, please don't hesitate to contact a member of the Buckingham Gate team. Thank you.